and welcome to Nanyang Business School Alumni Global Masterclass Series in Mumbai. We are delighted to have with us Mr. Cheong, Ming Foong, Consul General of Singapore in Mumbai, Dr. Matthew Dearth, Associate Professor Finance at Nanyang Business School, our distinguished speakers, guests, incoming students, and fellow alumni. My name is Ritika. I am Nanyang fellow MBA graduate from Nanyang Business School, president of NTU Alumni Association for Central India, and NBS Alumni representative in Mumbai. I am delighted to be your MC for this afternoon. We gather today during a special year of Nanyang Business School as we celebrate 3 decades of growth, excellence, and impact. Over the years, NBS has grown into a globally respected business school while remaining firmly committed to developing leaders who create positive change in business and society. As part of this milestone, we are proud to present the NBS Alumni Global Master Series. Following a success inaugural season in Beijing, today's program continues our commitment of lifelong learning and connecting the alumni committee across borders. Turning now to cross-border relations, we are honored this afternoon to have with us Consul General Mr. Cheong, who will address us and share his insights on bilateral relations between Singapore and India. May I now invite Consul General Mr. Cheong to deliver his opening address. Mr.
Cheong. Good afternoon, everyone. First of all, it's two congratulatory notes, actually. First is not too late. My Indian friends, congratulations on India's 77th Republic Day a few days ago. And obviously, you are all here as alumni or prospective students of NBS. Congratulations as well to NBS on 3 decades of existence. India has made remarkable strides in reforming and developing its economy. I've been here for about over 4 years now in Mumbai, and even within just these 4 years, there's been such visible improvements and developments. And not forgetting the initial part of my tenure here actually coincided with some remaining restrictions of the COVID pandemic. So if you discount that, the pace of development is even more remarkable. This development across the country has uplifted many and built one of the world's fastest growing economies, and is now a vibrant hub at the forefront of innovation. Our bilateral relationship has grown in tandem with India's transformation, underpinned by regular high-level exchanges, robust institutional linkages, and strong people-to-people ties. As you know, last year, in 2025, Singapore celebrated our 60th National Day. We also marked a significant milestone in our bilateral relations with India, as it was also the 60th anniversary of diplomatic relations. It was an opportune time to reflect on our relationship. It has been a fruitful partnership that will surely grow even more. But this happy state of affairs did not come about by chance. Indeed, at first glance, Singapore and India could not be more different. India is huge in every way which Singapore is not. India's geography and demography are multiples of Singapore's. Just to give a few examples, imagine for a minute your land area is over 4,000 times that of Singapore's. For every Singaporean, there are some 233 Indians. And at over US $4 trillion, your economy is well on its way to becoming the 3rd largest in the world, probably larger in the decades to come. Singapore's is roughly 15% of that. And since we are here in Mumbai, the headquarters of the Tata Group, I just looked it up yesterday. The Tata Group is worth about $446 billion That's only slightly less than Singapore's GDP. And that's just one company. Despite our vast differences, however, we have managed to build up very strong relations at all levels. And I would say that this is because we fundamentally, both countries, share very similar worldviews. The way we perceive the world and how we act within it, there's a convergence that belies our differences. At its core, both Singapore and India treasure what we call agency in the business, which is the ability to chart our own path in an increasingly fractured and unpredictable world order. And over the decades, we have both been remarkably consistent in advocating sovereignty of action, no doubt born of hard-fought independence for our nations. We are both instinctively wary of dominance by any single power and zero-sum competition. In short, we value strategic autonomy. So if we dig a bit below the superficial differences between our two countries, we will find a strategic like-mindedness that makes us at ease with each other. Indeed, I have sat in at many meetings between our leaders and senior officials over the years, and there is a comfort level that goes beyond personal warmth. We do not think about this all the time, but it is there, and I would urge all of us to occasionally reflect on this reality that underpins the excellent relations between our two countries. Both countries certainly do not take these relations for granted. This starts from the very top. There has been a very intense pace of visits by our top leaders, which serve to buttress our strong relations. I mentioned the 60th anniversary diplomatic relations just now. Last year, 1 year ago, the celebrations were kicked off by a state visit by Singapore's President, Tharman Shanmugaratnam, to India exactly a year ago, in January 2025. He visited New Delhi as well as Odisha. By the way, my office covers not just Maharashtra, but all the way to Odisha as well. I cover 6 states, east to west, Odisha to Maharashtra. So I was there preparing for President's visit to Odisha. And we were in the thick of this very important visit, and it went off very well. And you'll be aware that President Tharman's host for that occasion, India's President Draupadi Murmu, is in fact from Odisha. So the visit there took on a very special significance for everyone. A few months later, in August, our Deputy Prime Minister and Minister for Trade and Industry, Gan Kim Yong, came here to Mumbai. He was accompanied by the Honorable Chief Minister of Maharashtra, Sri Devendra Fadnavis. Both of them visited the GNPT in Navi Mumbai, where our port operator, PSA, has built and operates India's largest container gateway, which has a 2-kilometer-long berth. DPM Gan also inaugurated, together with Chief Minister Fadnavis, a data center in Thane that was constructed and is operated by CapitaLand, which, as you know, is one of Singapore's largest real estate developers. And then just the following month in September, our Prime Minister, Lawrence Wong, made his official visit to India, his first as Prime Minister. During his visit, and fittingly to cap off our decades of cooperation, PM Wong and Prime Minister Narendra Modi adopted the roadmap for a comprehensive strategic partnership, CSP, between our two countries. Across these high-level visits throughout the year, some 15 agreements and MOUs were exchanged. Significantly, they are all forward-looking and cover areas where we have complementary strengths, like renewable energy, advanced manufacturing, sustainability, digitalization, and connectivity. As PM Wong highlighted during his visit, the upgrade in our relations to a CSP is not just in name. It is a substantive and long-term commitment to strengthen our country's partnership as we navigate an increasingly turbulent world. It also serves as a forward-looking framework to guide the next phase of our cooperation. Allow me to highlight just some of the initiatives under this CSP roadmap. Firstly, we'll partner India to set up a National Center of Excellence in Chennai, which will focus on skills development in advanced manufacturing. We'll also work with India to set up state-level skill centers to meet industry needs in sectors like aviation, maintenance, repair and overhaul, MRO, and as well as training of workers for the semiconductors manufacturing sector. We agreed to establish a green and digital shipping corridor between our ports to facilitate shipping and support green fuels trading. In the private sector, I had mentioned PSA just now, where they operate, as I mentioned, PSA's, the Bharat Mumbai Container Terminal over in Navi Mumbai, which handles roughly 25% of India's cargo capacity. And we'll expand our cooperation literally into frontier areas such as space. More than 20 Singapore-made satellites have been launched by India, and we hope this partnership will broaden. Also in the digital domain, the cooperation has been quite encouraging. For example, in payments connectivity, in 2023, a real-time linkage between Singapore's PayNow and India's UPI was launched, and it continues to grow in scale with more banks being onboarded now. Starting from 6, there are now 21 Indian and Singaporean financial institutions on board. And of course, because of your common link to NTU, I will be remiss not to mention the educational aspect of bilateral relations. Over the past few years, I've witnessed a remarkable increase in educational links between both countries. Indian students studying in Singapore is obviously one part of it, but is by no means the only one. There have been numerous groups of students from Singapore, from many of our tertiary institutes, coming to Mumbai and India for familiarization visits or internships lasting anywhere from a week to a few months. In fact, I was mentioning to Prof. Dearth just now that between me and my colleague at the consulate, we spoke to 3 such groups last month alone when they were hosted by the Geo Institute. Our students, startups, and professionals are also getting to know each other better through the Singapore-India Hackathon. Its 4th edition was launched by SMU, the Singapore Management University, and the All India Council for Technical Education in November last year, and it will take place in Singapore over the course of this year. These are just snapshots, and all these streams of cooperation require close monitoring at the highest levels so we can continue to nurture this important relationship. And in this regard, the India-Singapore Ministerial Roundtable, or ISMR, will be the main bilateral platform to review and monitor the progress of this roadmap. The ISMR comprises at least 4 and recently 6 ministers from each side sitting down and talking to each other without the presence of officials. And they take stock of bilateral projects and chart the way forward for the 2 prime ministers to endorse. We have held 3 rounds of the ISMR so far, and Singapore looks forward to welcoming our Indian counterparts to Singapore this year for the 4th iteration. Dear friends, 6 decades ago, when Singapore established formal ties with India, few could have envisioned the remarkable partnership that would flourish between our nations. Today, India is not only a close neighbor but a valued partner to Singapore. Our nations are bound by deep historical and people-to-people ties, mutual respect, and a shared vision for the prosperity of our region. Once again, thank you for allowing me to brief you on the state of bilateral relations. I've only been able to give some highlights, and it's obviously a lot more going on. I also apologize that I can't stay for long, but please don't hesitate to reach out to me or my office should you want to learn more. We are Singapore public servants, so all our contact details are on the web, on the internet. If not, I'm sure Michelle and NBS can share my email with you as well. Please reach out and let us know what you're interested in. We'll be happy as well to include you in some of our events. Thank you, and I wish you a very good afternoon.
NBS Global Leader Program. With over 30 years of global finance experience, introducing leadership role at Goldman Sachs, Marshall Ways, and Silvercrest Asset Management. Dr. Dearth is an award-winning educator and author of the book Sustainable Finance for Returns and Impact. Please join me in welcoming Dr. Matthew Dearth.
Great, thank you so much. Good afternoon, everybody. Thank you so much for being here. I find it very hard to use a podium as a professor. I wander around all the time, so forgive me while I pace back and forth. This is just how it is in front of a classroom, so it's like you're back in school. Let's go with that. So let me tell you a little bit, whoops, I have it upside down. How about that? Here we go. Let me tell you a little bit more about myself, just by way of background. You might be able to tell I am American. I've lived in Singapore for 10.5 years. My wife is Singaporean. I'm a PR. I'm not going anywhere. I love it there. And I certainly don't intend to move back home anytime soon with all the fun that is going on in the US these days. I really like it where I am. I spent 30 years in a career spanning different parts of finance. So you can look at Goldman Sachs as an investment bank, Marshall Wace as an equity long-short hedge fund, Silvercrest Asset Management as an advisor to ultra-high net worth individuals and investment manager, and I spent time at Booz Allen and Hamilton and did a bunch of consulting with financial institutions. I've really enjoyed it. But when I moved to Singapore in 2015, I met somebody who was a professor at SMU, and he said, "Oh my goodness, you used to work at this hedge fund. I loved their strategy." He was familiar with it from industry himself. "Can you come teach at my MBA class? Just give a guest lecture." And I said, "Sure, I'd love to." 6 months later, he said, "Hey, I'm going back to industry. Do you want to teach my class?" I'm like, "Sure, why not?" I was, kind of trying to build my own business, and I had time. And that was the first step down the slippery slope into academia. I love it. And so what I do now as a professor of finance, I'm a practice professor. So my job is not to write papers. My job is to teach and to take what I've learned and try to share that with undergraduates, MBAs, executive education seminars, lots of different audiences. This is what I love to do. I do a little bit of research, a little bit of writing, and we'll come back to that as well. But sustainable finance and as well impact investing as a separate part of sustainable finance are the two things that I spend most of my time working on. I also have been recently invited to be the director for our new scholars program for the business school called NBS Global Leaders. And this is, let's see, we have 38 students out of an incoming class of over 1,000. Students that we've handpicked that we think really have the potential over their careers to be leaders in Singapore, Asia, or maybe even the world. These are some of our top students in the school. And so my job is to create all sorts of experiences for them over their 4 years that will help accelerate their development and hopefully lead them into what we think are going to be very high impact careers. So that's a little bit about me. And let me kind of tell you now what we're going to cover today. So I want to talk about how sustainable finance, which many of my students think is kind of an oxymoron. Wait, how do we put sustainability and finance together? Maybe those don't make sense. I will argue that that's not the right way to think about it. They, in fact, do go together. And so we're going to talk how we start everything by thinking about measurement and then disclosure. It sounds really boring. It's actually the domain area for accountants and all of that. It is actually super, super important to get right. Because how do you improve your relationship with people and planet if you don't know where you're starting from? We have to get that baseline. So we start there, then we move into, okay, so now I know where I start. I know what changes I want to make. How am I going to pay for it? Because it's not free. It takes money. And so we're going to talk about financing the change. We're going to talk about the importance of regulation and the role of government. Incredibly important. It has profound implications for many businesses and individuals. So we'll talk a little bit about that. And ultimately, as we go throughout this, this hour or so together, a little less than that, I'll try to give you some examples to try to make it a little bit real. Okay? So how many people recognize this logo? Okay, so one. It's about what I would expect. How about this one? Okay, same guy. Okay, thank you. That's what happens when you work at the stock exchange. How about that one? Maybe a few more? No? So Ørsted is actually the first utility in the world to go completely green. They used to be Dong Energy. That stands for Danish Oil and Natural Gas. They were basically they were the national energy company in Denmark. And so if you go back to before 2009, they were 85% coal, and they represented 1/3 of Denmark's carbon emissions. But COP15, so I'm gonna use as little jargon as I can. COP, hopefully some of you are familiar with COPs, right? So COP15 was held in Copenhagen, and that was in 2009. And at that point in time, also, Dong Energy was applying for a permit to build another coal-fired power plant, and it was denied. And so the CEO basically said, you know what? We are going to pivot. We are going to be 85% renewables and 15% coal by 2040. That was their goal. So they invested aggressively in offshore wind. They phased out their coal-fired power plants. They divested the parts that they couldn't convert themselves. They converted the remaining thermal coal plants to burn certified sustainable biomass, and they changed their branding in 2017 to reflect the culmination of this transformation. So this became the first one, not the last, hopefully. In the process, they had to write down $6 billion worth of assets. So it's not cheap. It's a lot of work, but it's possible. The first logo that I showed you, NL, we're going to come back to them because they're on their way. And it's another energy company. But my examples will not be limited to energy. We'll have lots of different things to talk about. I view sustainable finance, this is how I teach it in the classroom, as, and I didn't invent the idea of the three-legged stool, but I will borrow it here. There really are these three components to it. We have companies, we have investors, and then we have government and regulation. So if I think about the corporate side, what should corporations care about? Why should companies care about sustainability at all? They're just there to make profit, right? Well, increasingly we are recognizing that that doesn't necessarily lead to the kind of planet that we want to pass down to our great-great-grandchildren. But if we want them to change, they have to figure out how to pay for it. And so that's where we get to the investor perspective. And investors have the same challenge. Why should investors value sustainability? They're there to turn our money into more money, right? That's the whole point. Well, actually, maybe investors want to think about what matters to returns. And over time, sustainability issues do have a potential impact on financial returns. We're going to talk about it from a revenue perspective, an expense perspective, a risk perspective. It's important to get right, but in the end, investors have to figure out how to navigate this balance between this trade-off between sustainability and profits, because that's their job. Their job is to turn our money into more money, and sometimes that is a tension. Now, the final area, the regulators, their job is to figure out how do we even define sustainability? What counts? What counts as green? That sounds almost like a weird existential question. That's not at all. That is real. And it's the government's job to figure that one out. So we're going to talk a little bit about that. And ultimately, we rely on the government to put some guardrails in place to try to prevent as many bad actors as they can. we want to grow an ecosystem where all the different players are working towards a greener, a more sustainable, more inclusive future. So this is the overall framework. Today, due to time limitations, I'm going to focus mostly on corporates and government and regulation. So you can see me afterwards if you want to talk about the investors, because it's a pretty interesting part of this as well. Okay? So, why should firms think about changing? Remember, we started with the corporates. You know, what should they care about? Why should they change? There are plenty of examples of organizations that look at sustainability-related issues and identify opportunities, new revenue streams, opportunities to increase revenues, product transformation. Schneider Electric is one of the firms that constantly gets mentioned. Huge transformation in their business lines, and now the vast majority of their revenues are associated with sustainability-linked products and services. Expenses, reducing your current or future expenses. Lots of different ways to do this. By the way, this is not necessarily new. And I'll try to link it back to some of the concepts that some of you, I'm sure, are familiar with that have been around for a long time. Risk is another interesting one. It's one where my colleagues in the finance division at NBS who specialize in actuarial science, this is where I look to them because it's the insurance industry that's really going to help us out with this. We need better ways to quantify some of these risks that we're looking at, whether they're associated with climate change, the impacts of heat, it could be the impacts of severity of storms, flooding, drought. We get all of these different potential impacts. How do we quantify that? But depending on what business you're in, the risk may be very, very real. Even if you can't quantify it yet today, you know the risk is there. How do we think about incorporating that into what we should be doing as an organization? We also have to recognize that sometimes customers are pulling us. There's changes in demand. Customers prefer sustainability maybe in certain ways these days. How do you respond to that? How do you stay close to your customers? Sometimes they're not ready to pay for it. That's reality, right? But what happens when you start looking at your competitors? Sometimes your competitors are moving. Do you want to just be the last one? Say, you guys go ahead and make the investments, I'll show up later? Maybe. It's a strategy. Carries risks. And then finally, certainly we have all sorts of risks associated with the need to comply with or anticipate changes in regulation related to sustainability issues. So there are all these things that potentially represent reasons for companies to change. Now, the first step really is going to be, as I said before, measurement. You have to know where you stand today. And so this provides a baseline, establishes credibility. Some of that's internal, by the way, as well as external. Depending on where you sit, if you're a public company, certainly in most major markets around the world, you have obligations now to measure and report sustainability-related information. So you have to meet that. It will be increasingly essential for external financing. If you expect to get money from other people, banks, other forms of investments, without knowing the data and being able to share it, that's going to be a little bit harder. And then ultimately, what we've seen is that there's been a lot of work done over the last 20 years to improve our understanding of what we should be measuring and how we should be reporting it. So I want to give you just a little bit of an example. We've got the GHG protocol, GRI, ISSB, IFRS, IIRC, SASB, TCFD, but this is like garbage, right? It means something to those of us who are in this business, but it is kind of an alphabet soup. Does that term mean anything to you guys? Right? I grew up eating alphabet soup, literally. So, it is kind of a bunch of stuff. It's only marginally better when you actually put the names for the acronyms here. There's an entire course, essentially, on all of these different standards and how you do sustainability accounting and reporting. not going to do that. Just to say we have made a lot of work on what to measure and how to report. In many ways, this list should be a lot longer. It has been consolidating over time. That's the good news. There has been a lot of work done in places around the world. So we have a lot of work from the EU that has been kind of a trailblazer. A lot of work has been done here, right? So the BRSR standards, we have a lot of work that's been done in Singapore as well. So yeah, it's getting, I wouldn't say it's getting easier, but it's getting clearer what companies should be looking at. That's really important. Now, raise your hand if you're familiar with this concept of scope. Okay, so maybe 40% of us. So the idea of scope is when you are thinking about what to measure, and let's think about it specifically with regards to climate change, and so therefore greenhouse gas emissions. The idea of scope is that we start with scope 1, which is kind of in the middle. This is you are burning the fossil fuel. You are generating through your operations the CO2 or the methane or whatever it is that is going into the atmosphere and contributing to global warming. Scope 1. That's yours completely to control. Scope 2 is a little less direct. We'll call that indirect. This is, if scope 1 was I burn it, scope 2 is I buy it. I pay somebody else to generate the electrons that I need. So this is buying from the utility. Purchased electricity and the emissions associated with purchased electricity generation. Also important. So you can see that with scope 1, I am burning the fuels myself. I get to choose what can I be working on to get me to a place where I burn less myself. Then, once I've electrified things, and so now I'm relying on a utility to give me the electrons, how can I be more efficient? I want to buy fewer electrons, right? So these are very much things that wind up being kind of in control of the company. But most of this graphic is actually dedicated to what we call scope 3. This is the value chain, upstream and downstream. 17 categories of activities that you could potentially be working on if you collaborate with your supply chain. So the best companies these days are actually spending a lot of time not just thinking about their own organization, but thinking about how their organization chooses to interact with its supply chain. Think about product design. Think about sourcing. Think about end of life. How do you design for reduced wastage and things like that? There are all sorts, or recyclability, all sorts of things that companies can do to think about the life cycle of their business and where they can reduce emissions along the entire chain. So this is kind of giving you a sense for where we start. This is what companies need to be doing. And sorry, this kind of got smushed up here at the top. Now let's imagine that you've gone through that exercise. You've gathered your data following the best frameworks and methodologies to capture everything, and you've thought very, very deeply about not just your scope 1 and 2, things you directly control, but also your relationship up and down in your supply chain and your value chain downstream, and you've identified things you want to change. But it takes money. So the financing broadly falls into 2 categories. Simple. First is internal financing. Use my cash flow as an organization. I kind of pay for it through normal means. I don't have to go out and finance it. I kind of do it through the financing of my own business, right? The fun part comes when you actually go out to a bank, when you go out to the markets and you try to raise capital that's external. And so here, I'm going to differentiate between sustainability, specific types of financing, or what we'll call vanilla instruments. These have nothing to do with sustainability. That's basically what we've seen mostly forever in terms of financing. It had nothing to do with sustainability. It was just, I issued a bond. Yay. Right? So it didn't need to be sustainability related. 2 categories. The former category of sustainability designated instruments is growing rapidly. So we'll tell you a little bit more about that. The major types are differentiated into loosely 2 buckets. The first is what we'll call use of proceeds financing. This is where you're going to give me $100 million, and I have to tell you what I'm going to do with it first. So when you look at, I'm sure some of your companies have issued bonds before. And if you were to read that bond prospectus, it would say the use of proceeds is for, I don't know, to pay down some debt, or, oh, we just bought this company, or general corporate purposes. Like, if I want to buy a ski chalet in Switzerland, I can, because general corporate purposes. That doesn't work with one category of sustainability-related financing. I have to tell you, this is exactly what I'm going to be doing with it, and then I'm going to have to persuade you that that qualifies as sustainable. We'll come back to that. The other category, actually the proceeds are completely fungible. But I use KPIs to indicate that, in fact, I am concerned about some sort of sustainability-related things, and I want to make these changes, so I will tell you how I am going to project my organization's performance into the future. Here are my KPIs, here's my target, and then we'll talk about what happens if you make or miss that target in the future. So a couple different ways to go to market to raise capital with sustainability in mind. These are available with bonds and loans, okay? And these are, oh, I did not get the, interesting, this is not the most recent version of the deck. Okay, so this is also available to corporates and governments and multilateral development banks. So India, just a few years ago, started issuing sovereign green bonds, as an example. So we have lots of different ways that this can work. Let me, actually, sorry. This is the right deck. I just got confused on where I was. So that's the last point here. And yep, here's my examples from India, going out and raising capital for green-related projects. Green is the type, or the flavor, the color of use of proceeds financing that is most common in the world, but it's not the only one. So we have green bonds, we have social bonds, and we have sustainability bonds. Sustainability is green plus social projects in the same bond. We saw a real acceleration in the issuance of social-related bonds in 2020. Any idea why? COVID. Yeah, like all those things that governments had to do while we were just at home, like, ordering delivery and streaming Netflix, right? They actually had to pay to, provide the social support. And depending on where you were in the world, there was a lot of social support that was provided. And governments were able to tap into this form of financing as a means of paying for that. I know we certainly did that in Singapore. We had a very large offering in 2021. So this is increasingly normal, I would say, social bonds and sustainability bonds, but it varies highly by geography, by region. So for example, in ASEAN, there have been very, very few social bonds, almost none. Plenty of sustainability bonds and a lot of green bonds. But standalone social is not so much an ASEAN way of approaching it. So it's not a good or a bad thing, it's just a thing. So it's kind of interesting to observe. Okay? So that's the use of proceeds bonds, green bonds, social bonds, sustainability bonds. Now let's turn to sustainability linked bonds. That's what this KPI-driven financing is. Remember, a green bond, you have to show the project is green. You have to convince somebody. I'm going to talk about where that comes from in just a minute. With these linked bonds, KPI bonds, no, you can, again, you want that ski chalet, corporate chalet? Yeah, why not? Get another corporate jet? Absolutely. As long as, when you've raised that capital, you said There are certain KPIs that we are going to pursue that have a sustainability component. It could be more women on our board, right? That would be one part. It could be we are going to reduce our emissions by 20%. Yep. We're going to reduce our water usage. Lots of different things that you can do. I'll show you an interesting example here in a few minutes. But the issue is that the company has figured out certain things that it wants to work on, and then it tells its investors, we're going to get to a point in time where we're going to take stock. Did we meet these KPIs and the targets for these KPIs? If we met them, or if we didn't meet them, we can change the interest rate that we pay to the market. Kind of interesting. It's almost like, your incentive compensation at your firm being dependent on whether or not your part of the organization meets certain targets. Anyone in sales? Yeah? Ever have a conversation like, oh yes, so surely I will make, X millions of dollars, or I'll be up 30% next year or whatever. That's your negotiation with your boss. Do you really want to have a super ambitious target? No, you want like the least ambitious target you can get away with, so you have the highest possible probability of meeting your target and getting your maximum bonus. Same thing here. Same thing here. So what can happen is we have the initial coupon, but that's, say I pay 8.25% on a bond. And then through time, 1 year later, 2 years later, whatever, I get to this point, T plus X number of years, 7-year bond, this is year 5, something like that. And depending on whether or not I hit or miss that target, I can either choose to pay the market more, meaning like I missed the target, so I'll pay you more, or I made the target, so I'm going to pay you less. Which one do you think the company wants? Do they want to pay the market more or less? Pay less, right? What do you think the investors want? You see how this gets fun, right? Yeah. So this becomes kind of interesting. Let me use an example from Thailand. Thai Union, one of the world's largest producers of frozen shrimp and fish. So Singapore's first chief sustainability officer was a woman by the name of Darian McBain. She went to Thai Union to be their first chief sustainability officer. And this was something that she was able to get across the goal line. They came up with 3 KPIs as part of sustainability-linked financing. And by the way, I've been using the idea of bonds when I've been speaking. You can do this with loans as well. And we see actually a lot more activity now on sustainability loans, green loans, sustainability-linked loans, than we do on bonds. Right? One of the reasons why is that with a loan, it's you and the bank. I don't have to tell anybody about it. Right? I don't have to disclose all the same information as if it were a bond, when I actually have to disclose it to the public because I'm selling it to the public. So yeah, this is definitely something a lot of corporations are considering. They'd prefer to do the loan, in part because they don't have to disclose as much information. Thai Union did both in this transaction. They did 3, trying to think if I put the number here. No. So they did, I think, 3 bonds and 2 loans, or vice versa. So 5 different instruments. It was like $800 million, which is real money. Right, so they raised some real money. And they had 3 different KPIs. The first KPI said, we intend to be included in the Dow Jones Sustainability Index for emerging markets and rank in the top 10 companies in the food products industry. That's going to be our number 1 KPI. Sounds ambitious, right? That's good. We're going to be in the top. Does it sound? How does it sound if I told you that they had been in the top 10 for food products for the 3 years before they issued these bonds? A little less ambitious. A lot of work. When I had Darian into my class, she was just like, you have no idea how much work it is to do this. I'm like, oh, it's great. I like the work. Sorry. Thank you. But does it make a difference? I don't know. Hard to say. Let's move on to KPI number 2. KPI number 2, we are going to reduce our scope 1 and scope 2, burn it or buy it, emissions from manufacturing by 4% annually. That's on a carbon intensity basis. Come back to that. Okay. So here we have emissions. This is something that they're going to focus on. Now, there are a couple of different metrics that people use. So if we go back to the standards and frameworks, I guess what we'd probably want, like what the atmosphere cares about, what's the haze today, like 300 and something, right? It cares about absolute emissions. But if I were to compare the GDP, as the council did today, of Singapore and India, in a way, it's kind of like apples and dishwashers. They're, one's giant country, one's small little red dot. You often look at that on a per capita basis, right? If we were to compare Mauritius and China, you wouldn't do those in absolute terms. You would look at it on a per capita basis. That's the idea of emissions intensity. So it's actually your emissions usually per dollar of revenue. So I can control, or compare, I should say, between companies of different sizes. That sounds great, but there's a problem. If my emissions goes up, but my sales go up more, it looks like my emissions intensity is going down. I can tell you the atmosphere does not care about that. Right? So again, these are the sorts of little details in this space that make it a lot of fun. So for a first bond, first time doing this kind of financing, it's great. They've started, right? When a lot of countries get started with their commitments, they're what they call nationally determined contribution to climate change. A lot of times they start with these kind of intensity measures, and then over time they can work towards more of an absolute sort of measure. It's the same with companies. So you just got to get started. So this is good. It's not what is the most ambitious, but it's a start. Now the final one is, again, this is a fishing company, so completely different. This one says we will have a target to increase the percentage of tuna purchased from vessels equipped with electronic monitoring and or human observers from 71% to 100% in 4 years. Sounds good, right? I'm sure there's a way to criticize that. I don't know what it is. It's like, yes, go do more sustainable fishing. Okay, so they've got these 3 different KPIs, and they have targets for those KPIs. Now remember, that was the first part of this financing instrument. The second part is what happens if I miss it or meet it? Here's what they did. They said if SPT1 is achieved, we will reduce our original interest rate by 0.02%, 2 basis points. Now, the original interest rates are either 2.27 or 3.36%. You can tell these are done at a point in time and in a country where nice low interest rates, right? Yeah, it feels pretty good. Yeah, not necessarily going to be true everywhere all the time. If SPT, remember this one is the Dow Jones Sustainability Index, then we get to the second one is about emissions intensity, and then we get the third one is tuna. Okay? So 2 basis points, 4 basis points, 4 basis points. The idea is if they meet the target, the rate goes down, saves them money. They pay less interest to their investors. And as we said, the investors, that's not, it's like, okay, I'd prefer you either pay me the same so I know what I'm going to get, or, paying me more is not a bad thing. So they actually did that too. They said, oh, well, if we don't achieve all 3 of these, then it goes the other direction. So if they miss the target, the rate is increased. They did both. Now, my friends who are investors in fixed income and look at sustainability, I asked them, and they said, yeah, It's kind of a pain. But if that's your job, this is what you do. It's, no one said it was going to be easy. Making money's not easy. So you just dig in, roll up your sleeves, and you try to figure out what are the odds that Thai Union's actually going to miss or make on these different KPIs. And then you look at the credit worthiness of the issuer, because it's still a bond, right? And then you try to figure it out. So this is one of the more complicated examples I can give. I like it because, first of all, it's got some weird KPIs. Second, because it is complicated. It goes up, it goes down. But also look at the quantum, 2 basis points. One of the challenges I see in this space is that it's hard to convince me that this is economically meaningful as either an incentive, carrot, or a stick, a potential penalty if they don't get it right. It's just not. I mean, if this was, if they were raising $1 gazillion, 2 basis points on $1 gazillion is a lot of money. But 2 basis points, it's also just on the portion that hasn't been paid yet. So if these are 5-year bonds and it only covers the last 2, then it's just the last 2 years worth of interest payments. I mean, yeah. So there are lots of things that you kind of have to look out for if you're on the investor side. So I said I wasn't going to cover the investor side all that much. This is kind of just a little throw that in there. But ultimately, all of these bonds follow some kind of standards. It gives the investors some comfort that, hey, we actually are creating this bond the right way. So with the bonds and the loans, by the way, all of these different, so it's sustainability linked, green, social, sustainable, all of these, the International Capital Markets Association is the body that maintains the principles for this. So it says, first, the projects have to be green. Right? If it's a green bond, projects have to be green. Second, you got to show me how you pick the projects, so I know your project selection and evaluation criteria. Third is you have to show me what you're doing with the money. Where does it go? Like internally, do you just throw it in the pot with all the treasury? Do you have a special purpose vehicle and you put it there? How do you do it? And then fourth is you need to have some sort of accounting, some sort of reporting once a year to tell us that in fact you are spending the money the way that you said you were going to spend it. Now, the last part of this is that bit about green, and we're going to hear a lot more about this from one of our panelists who actually does this work for a living. So very happy to have Manisha with us today. But governments create what are called taxonomies. Taxonomy is basically a way of describing this is what counts as green for financing. Note that we don't yet have full-on taxonomies covering the social parts, but we do have things within the taxonomies for even the green parts that address some components of social in some of the taxonomies. So there are standards that can be referred to, so it's not a black box. In the early days, there were no standards. People could come out and say, yes, this is green. And you'd be like, why? Why is that green? One of the big ones actually kind of relates to one of the questions here. This is, why would a company actually bother to use these kinds of financing instruments? And in theory, there are probably 2, maybe 3 reasons for this that I often see. First is maybe it will be cheaper to finance this way. I get a benefit, right? The market actually will give me cheaper financing because I'm doing sustainability related stuff. If that's not the case, maybe these bonds actually will wind up being lower volatility in the market and investors will like it. So they're going to want to buy my bonds. In part because, again, I'm doing sustainability related stuff. And because I'm doing sustainability related stuff, I'm potentially reducing risk. And if you're talking about a 30-year bond, there could be a lot of risk out there. So anything that reduces the risk in that kind of situation is a good thing. So there's those 2 are kind of real economic. There's also, maybe this is signaling value. Hey, I'm serious about being better for people and planet. Okay. Or maybe it's just greenwashing and yeah, I'm just trying to get away with it. There's a lot of that, unfortunately. Now, my answers to these, there is some evidence that the green bonds in particular have, at certain points in time in certain markets, actually enabled firms to get financing more cheaply. And even today, if you picked an issuer, you might see a bond. Basically, when I say give cheaper financing, it's like if they were to raise that money through a, remember I used the term vanilla bond. If I were able to do that at, say, 8.25%, maybe I could do this bond, if it's a green bond, at 8.15, right? So I saved 10 basis points. So that's a saving to me. In the market, they call that a greenium. I did not make that up. It is not a premium, it is a greenium. So maybe, and that has existed, like I said, certain points in time, certain markets. But it's not universally true. And in fact, it's not as true today as it was, say, 4 years ago. Second one, lower volatility. We absolutely saw this during COVID. Green bonds actually did not draw down nearly as much as the vanilla bonds, even when the issuer was actually a little bit of a sustainability leader. So the green bonds demonstrated better characteristics, performance characteristics in a volatile market that way. And then they recovered up to where they were before, just like the other bonds. So that's kind of interesting. The signaling value, again, do we put a value on that? I'm not 100% sure. And the evidence on greenwashing, there's a really interesting study that some folks did in the US looking at the proceeds, what the proceeds are actually being used for. And it was something like less than 10% of the proceeds were used for what were considered novel projects, like new things that the company wasn't already exposed to, really trying to go in a different direction for sustainability. In fact, the majority of the proceeds were used to refinance stuff that had already been done. Again, I'm not 100% sure that the atmosphere cares about your refinancing. It cares about reducing emissions. So, yeah, the tools are there. It's all a question of how they're being used. But the tools are there. So it's not a bad thing. But we can't just go out there and say, yes, every time there's a green transaction that we should just naturally stand up and applaud. You have to be discerning when you look at this. Okay, let's now we've talked about start with the measurement, understand what you are trying to do as a business. Then we are going to try to talk about the ways that you could finance any of the changes that you want to make. Why would you do it? It could be revenues, it could be costs, it could be risk. Respond to customers, respond to competitors, regulators. Let's now come back to that first logo I showed you. This is the company NL. NL is trying to do what Dong did. They are, an Italian fossil fuel electricity company. Coal, some gas. They said, nope, we actually want to transform. We want to be a green company. They did their first sustainability-linked bond transaction, one of the first ones ever. I think it might have been the second, in 2020. So you can see how new this market is, right? It's one of the things I love about teaching sustainable finance is that it's just changing constantly in front of our eyes. It means it's a lot of work, but it's really exciting. So these guys in 2020 raised 500 million pounds in a 5-year bond. The interest rate, so again, that idea of the rate changing based on a KPI. So the KPI was renewable installed capacity. What percentage of their installed generation capacity was renewable? And at the time that they were issuing the bond, it was 51.9%, and they said, we want to be 60% in a year and a half. I think I got that right. 2.5 years, sorry. The results were going to be certified and audited, and then if the target wouldn't be met, they would pay an extra 0.25 point beginning in 2023 for the last couple years of the bond. Okay, so that's a good example of what they were trying to do. They are the world's most prolific issuer of sustainability-linked bonds, over 30. And one of the things that they did, this is probably a little hard to read, but let me walk you through what this summarizes. This shows us at different points in time, let me start from over here. Starts different points in time. This is October of 2020. Something I didn't cover, there's something called a sustainable finance framework. Basically, it's a way for a company to say, this is where we're headed with our sustainable financing. So they said in October of 2020, they're going to have 2 separate KPIs. The first is renewable installed capacity. That's what we just saw. They were getting up to 60% by 2022. So we see it, it's right here. But they also introduced Scope 1 emissions intensity, grams of CO2 and equivalent gases per kilowatt hour of electricity, 125 grams by 2030. Okay. That's your starting point. January 21, that is 4 months later. They go, okay, we are now, for 2023, they're moving 1 year forward. Now we're going from 60% to 65. And now we have, if 125 is 2030, we now are going to cut that by a third. Now we're going for 82 grams. And we introduce a near-term target of 148. So you can see this in 4 months is an increase in ambition. Fast forward again, 1 year later, boom. Now they're saying 65 to 66, so it slows down the pace a little bit. But all of a sudden, look at this, 100% green by 2040. 0 carbon emissions per kilowatt hour. 100% renewable by 2040. That's their goal. And then they went really crazy a year later and they added a whole bunch of other KPIs in there and stuff like that. Now, I love the ambition, right? Very ambitious goals. I like the fact that they're giving us something that's kind of more operational, like what percent of its installed capacity, as well as the carbon intensity, which tells us about the energy mix as well. There's this little problem. Anybody know what happened in Europe a few years ago? Like around, I don't know, the country of Ukraine? Anything? Yeah, that. So all of a sudden, yeah, we've got supply disruptions in natural gas. Europe has been completely beholden to Russian natural gas. And so here's what happened. They missed their 2023 target because they had to keep some coal plants online longer than they thought. Now, this headline I love. Small miss for NL, big step for the sector. The small miss, their target was 148 grams. We saw that on the previous page. They got to 160. They missed their target. By the way, that's down 56% over a 6-year period. They are reducing, but they missed their target. That cost them 83 million euros because they have so many different bonds. So over the life of the bonds, when you miss that target, your interest rates went up, 1/4 point on each one. And so the big step for the sector is, you know what? It's real. It has teeth. It costs money. Like maybe these things, these sustainability-linked bonds, maybe they're actually like meaningful. That's kind of the idea. So ultimately, it's going to cost them a bunch of money, but it's a way, because there's no force majeure clause in one of these bonds. It's there, right? Oh, there was a war, so I get to, hey, sorry, there's a war. No, it doesn't work that way. But it's real. So this is like real skin in the game, real change. So that's NL. There are tons of examples. If you Google these, you will find them, right? So it will be the spice company, McCormick, right? So they were looking at sustainable sourcing. And what are they finding? Well, they're going to have lower cost of capital, risk management, and estimated benefits. This is actually a relatively old example. I think this is at least 5-6 years ago. McDonald's, here's that idea of scope 3, partnering up in your value chain, partnering with Carrefour, and looking at deforestation-free supply chain for the beef in their burgers. Okay, so you get benefits to the ranchers, you get benefits at the slaughterhouse, you get benefits at the retailer. Now, anybody remember Lean Six Sigma? This is not new. It's really not. My wife's a Lean Six Sigma black belt. She's like, I've been doing sustainability forever. We just haven't called it that. It's possible. We know how to do this. Many of you and in your organizations, you know how to do this. All right? We just have to do it. Now, one of the reasons why we have to do it is because we have regulation. And regulation, I would argue, it may not go in a linear direction, but over the next 20 plus years, it's going in one direction. We're not going to see massive relaxation of environmental regulation. We're not going to see Europe go, we've been doing this whole emission trading system thing. Shut it down. No worries, guys. Do whatever you want. Not going to happen. We have regulation to contend with wherever we are. We have changes in environmental standards. We have changes in the reporting requirements, so back to the idea of measuring and disclosure. We also have putting a price on pollution, taxes. This whole thing about carbon emissions, greenhouse gas emissions, because it's not just carbon dioxide, it's methane, it's nitrous oxide, fluorinated gases, there's kind of this cocktail of gases that contribute to global warming. This is one of the great examples of what Nobel Prize winner William Nordhaus identified as a negative externality that is not being priced. Negative externality is when a company does something, it causes harm to somebody else, but they don't have to pay for that harm. Right? I dump stuff into the river, it kills the fish, it pollutes people, people get sick, all of that. I don't have to pay for it, then guess what? Fine. So it takes the government to step in and say, thou shalt not dump your stuff in the water, and we will come around and inspect you, and we will fine you, and all that. And then you go, fine, I'll figure it out, right? And then companies have to deal with it. So what we have here in carbon pricing, I think, is one of the great challenges ahead in the next decade. We have, in the EU, they already have something. They have their exchange traded system, emissions trading system, the ETS, that sets a price for many of the most serious emitting industries in Europe. I think it's probably around 65, 70 euros right now, something like that, per ton of CO2e. They just, a few years ago, proposed something called the Carbon Border Adjustment Mechanism. 6 industries, including things like steel, cement, aluminum, fertilizers. If a European company buys those materials from abroad, it will basically have to measure the carbon emissions and the taxes, if any, paid at the point of production. And if that essentially was less than it would have cost to buy it in Europe, where there is a price on pollution, the company is going to have to make up the difference. So it's basically no cross-border carbon price arbitrage. Now, it was proposed, it's still not being implemented, industry is pushing back furiously, it's being delayed, it is coming, whether we want it to or not. When it was first announced, I believe it was within 6 months that Thailand said, we're going to start putting a price on carbon. It matters. It matters a lot. And so what we have here in India, so we've got the carbon credit trading scheme that was proposed, and that's being rolled out. And then there was a talk about could you do or should you do an emissions trading system or a carbon tax. So India's starting, first step, carbon credit trading. In Singapore, we went we were the first country in Southeast Asia to implement a carbon tax. We put a 5 Singapore dollar price on a ton of CO2 equivalent emissions, which did largely nothing because it's immaterial. But it went from $5 to $45 effective January. And the visibility is within 2 years, it should be somewhere between 60 and 80. Now, Singapore's in the enviable position of having a lot of money and few people, and so they are able to get away with this, essentially. They can provide the social support needed to compensate people for the increase in electricity bills, et cetera. Good luck doing that in Indonesia. Good luck doing that here. It's harder, right? But this is real. It is coming. So companies should all be thinking, how do I get ahead of this? I need to be doing the things that can be done. Some of them are things that we know about and have known about for a long time. So I'll describe this as we have to do, what's the movie? Everything, Everywhere, All at Once. We kind of have to do that. Now, I'm going to show you, so the setup doesn't allow me to have the computer over here at the podium, so I took a series of screenshots. You'll have to bear with me. What I usually do here is I use a simulation called En-ROADS. En-ROADS is put together by MIT and a nonprofit called Climate Interactive. You can see the name of this thing is up here. En-ROADS, EN-ROADS. I highly encourage you to play with it. It's free. It's on the internet. If you are a climate geek, there are like 40,000 equations. They make all the equations public, all the values public. It's as open source as you get. And they tie it back to all of what we call the integrated assessment models, where we do all of our climate forecasting. Now, the fun thing is they use a field called system dynamics. It's kind of control theory. It's a way of thinking about stocks and flows and the way things influence each other, to give us an interface that allows us to play what if. And the target is up on the far right, 3.3 degrees. Right now, based on actual implemented policies, not what people say they're going to do, not what countries have promised, actual policies in place today, we're on track for 3.3 degrees C global warming. That's a world of hurt, right? So we need to do better than that. So we can see, this is on the right-hand side, greenhouse gas net emissions. So we're at kind of on track. We're here at around 60 gigatons a year, and we're kind of flatlining, but right now. That's like saying I'm filling up this bathtub, it's overflowing, and I've stopped opening the tap more, but it's still putting in 60 gigatons a year. Bad. So we have a whole bunch of slider bars to play with down here that enable us to say, well, what if we made some changes? What would happen? And specifically, one of the things we're going to look at is, where do we get our electrons? That's the top left. So this is sources of primary energy globally, exajoules per year. Right? As a species on a planet, we use a lot of energy. And so we've got coal, oil, and gas here in the bottom. That's our traditional fossil fuels. Renewables in green, already expected to grow a lot. And we see it, right? Bioenergy is already there. Nuclear is there. You can't see it because it's washed out. It's very, very small. New zero, fusion. I know you guys are working on small modular reactors as well. There's a lot of really interesting stuff happening in the new non-zero space. But really here we kind of mean fusion, if you want to just keep one in mind. So that's what we have at the top. That's what we're working against. And we get to play with different kinds of levers. So on the left-hand side, we've got a whole bunch of things we can do to influence the energy supply. coal, we could put a big tax. So you'll see this is the status quo. If I move it over here to the left, that means I create a tax on coal or a tax on oil, trying to discourage the use of that fuel for electricity generation. Same thing here with bioenergy and renewables and nuclear. I could go either way, actually. I could tax it or I could incentivize it. And then we get to new zero carbon. Let's assume that we can, we're going to get that breakthrough tomorrow. We could scale it as fast as we can imagine. And then down at the bottom, a carbon price. So a carbon price applies across all carbon fuels. So that's the left-hand side, energy supply. In the middle, we have transport and buildings and energy. And here we can either be efficient, energy efficiency, or we can electrify stuff. We're already doing that with EVs, but we can electrify more and more and more. The two at the bottom, I don't tend to use. Their population, are you really telling me we're gonna identify a couple 100 million people to cull the herd and shrink the population? I mean, maybe there's some Malthusians in the room that want to have that conversation. I tend to ignore that one, right? That's more like an output of whatever we get to. Although the model doesn't actually work that way. You won't see that change down at the bottom. And then on the right-hand side, we've got some other wonky stuff. Carbon dioxide removal. So it can be planting trees or it can be direct air capture, stuff like that. We've got other sources of greenhouse gases. This can be industrial. So it could be rice, it can be livestock, waste and leakage. When we transport gas around, some of it leaks. The methane escaping from old mines, all that kind of stuff. And then deforestation. Let's keep the trees in place, and that enables them to take more carbon dioxide out of the air. So, why am I going through this? Remember, the whole point here is we have a ton of stuff to do. We've got companies that have complicated supply chains, lots of different relationships with different suppliers and customers in different countries, lots of things companies can do. We actually need to do them all, and let me show you why. So when we play with this, the first thing I'm going to start with is here in the middle. Let's start with industry. So buildings and industry and transport. Let's start by making them more energy efficient. Look at what happened. We immediately go from 3.3 to 2.9. Now, I went to highly increased. I maxed it out. Okay, with all of this, if you decide you can't use this model on your phone. You've probably already figured that out. It's a desktop-only thing. But the three dots here, if you click on that, as you'd expect, it pulls up a sub-menu, and you can see all the different variables. You can get really complicated, actually, when you try to think about what the tweaks mean. But for right now, I just maxed those out. We already get down to 2.9. Okay? Next, let's come over to carbon dioxide removal. I move those to medium growth, plant a lot of trees, direct air capture, scales, all of that. Get another 1/10. Then I come down to other sources of greenhouse gases. This is actually really powerful in part because these greenhouse gases are really bad. Methane is much worse than CO2. Much worse. 30 times worse. So let's do that. And so that actually winds up making a big difference. So now all of a sudden, we're already at 2.4. We haven't touched energy supply. Oh, we're burning coal. Oh, we haven't touched it. So now let's touch it. Let's see what happens. The first one my students always want to do is, hey, Prof, let's incentivize renewables. I'm like, great, let's do that. It does largely nothing. We're already doing it, and in many parts of the world, not as common in emerging markets, unfortunately, because the cost of financing is actually a little bit high, but in many parts of the world, it's actually already cheaper than coal, right? So actually, you don't get as much bang for your buck on the renewable side, but it adds a little bit. The real leverage is the carbon price. Because this, and I could have shown you what, because I'm doing screenshots and highlighting, I'm like, okay, I'm only going to do so many of these. If you do coal itself, that'll make a difference, but not as much as a carbon price because it applies to all of them. Coal, nat gas, and oil. And so if you use a high carbon price, you can get to 2 degrees. That's the Paris Agreement. Below 2, hopefully 1.5. We're already pretty much at 1.5 right now. So if we could actually clip it at 2, declare victory and go home, right? That's a big win. The problem is, what do you think I used as a value for this carbon price? Anybody have an idea? How much? Like, give me a price in dollars. $45? $100? Do I hear more? No. So let me tell you. So I was doing a little bit of reading on the proposals for potential or simulation for potential carbon price here. And I don't do crore very well, so you'll have to forgive me. But it seemed like it was kind of, the proposals were like 2,800 crore? Something like that? What was that, like around $35-ish? Something along those lines? Okay. So that I was like, oh, let's play with that. On the other extreme, the International Energy Agency says for companies to feel compelled to make meaningful changes to their operations, the price needs to be about $125 US dollars. That's the number I used. Higher? So at a baseline, now by the way, that is emissions weighted. So the way that this works is all of these numbers in the simulation wind up being kind of weighted across all countries based on the emissions. So anybody want to guess what $125 carbon tax looks like in India? I'd say that's kind of fantasy land, honestly. Right? I mean, that would be remarkable. So we're not there. We're just not there. But we have to keep this on the table. We have to, because otherwise, we did everything we could. We got down to 2.3. Now, 2.3 is still not a comfortable planet. It really is not. So we still need to do all of these different things: energy efficiency, nature-based and technological removal, reduced agricultural emissions, waste and leakage, deforestation. We've got to do all of these things. And yes, we should continue to incentivize renewables. But we've got to have governments stepping up to support us with putting prices on this negative externality. If we do that, we can get to a point where, I don't know how many of you are familiar with shotguns versus rifles, right? So excuse me if this falls flat. But this is the director of Climate Interactive says, there's no silver bullet, but there may be silver buckshot. Lots of little things can add up. And that's kind of what I just tried to illustrate. So not every company has to go through an Ørsted or an NL and a complete transformation from brown to crystal green, if that's a thing. It doesn't have to be that. Quick wins add up. And by the way, those quick wins may actually be more likely to have a positive NPV, right? So in your organizations, you should be looking at all of these things and use the tools that we already have in business. Lean Six Sigma, whatever it is, right? There are opportunities to do this. And the financing is there. When you have projects that you think are going to make a difference, the financing is there. Banks are incentivized to green their loan book. They're incentivized to make capital available. Investors are increasingly taking these factors into account. It matters. And if you decide to wait, that carries risks. You don't know what kind of regulation is coming. Very dangerous. So, anyway, that's my masterclass. A complete self-serving promotional shot here. I just published a book. If you liked this material, and I hope you do, it's very real. I wrote this book basically to be like how I teach it. So it kind of follows this. It follows the 3 legs of the stool. I don't know how to buy it in India. but it's with Wiley. My co-author, James Cheong, has just joined the CIO office at UBS. We have a lot of really interesting interviews with practitioners in there. So it's not like a traditional college textbook kind of format. It's more like how I just spoke to you. You'll recognize my voice very clearly if you read it. Let's put it that way. So thank you very much for your time and attention, and I look forward to the panel and our discussion that's yet to come. Thank you.
She is a sustainable finance consultant at Empire Global. Next, please welcome Mr. Atul Srivastava, Head of Operations Excellence at Yes Bank. Finally, please join me in welcoming Mr. Ashish Garg, President, Business Head at Epsilon Carbon Private Limited. Please give our speakers a round of applause.
Great, thank you very much, Ritika. And thank you, panelists, for joining me up here. Everybody's tired of hearing me speak. I'm looking forward to hearing you speak. Why don't we, actually, I want to just check in. I know I went too long in my master class. How are we on time? We okay? Okay. 5-0? Okay, 5-0 minutes, and I know that's what stands between us and some drinks and refreshments, so we'll keep to that. Okay, so why don't we start off? I'd love to have each of you introduce yourselves to the group. You'll do a better job than I ever could. So maybe, Manisha, we can start with you. Would you just take 5 minutes to kind of walk us through who you are, why you're here, and what you're doing that's related to sustainability?
Hi, everyone. Thank you, Professor Matthew. Your talk was really brilliant, actually. For somebody working in sustainable finance, it was amazing. Hi, everyone. I'm Manisha Joshi. Right now, I'm working as a consultant with Empire Global in sustainable finance. I was a software developer, back in 2005, but then I decided to do environmental science and engineering, and I chose NTU to do my master's degree, and it was a brilliant experience that we had. It was part of the Singapore-Stanford Partnership Program. Back then, we had 1 quarter in Stanford and 3 quarters in NTU. We had the best professors, I think, and the whole environment, was so supportive, and having an NTU degree in Singapore was really helpful for us to navigate the job market in Singapore as well. So I ended up working as an environmental consultant in Singapore initially. I did a lot of EHS audits, due diligences for corporates, for vendor audits, corporate audits, mergers and acquisitions, that sort of thing. I did a lot of air emissions modeling, site assessments. I think that was like my first exposure to understanding compliance, environmental compliance, to the Singapore laws, to the laws within the region we were working across APAC. And after that, I moved to the US. I had a short stint of work in the US as well, and later moved back to India to work in my family business, which was into electrical components, quite far from my area of interest, which was sustainability. And I actually started like a sustainability division within the business that deals with smart water monitoring, measurement. Like you were mentioning, you cannot manage what you can't measure. So it's about how you measure and then monitor and then try to control the water usage in industrial facilities. So that's something that we are doing. And I also tried my hand in the retail segment, making reusable, foldable bags to combat single-use plastic, because Bangalore is, littered with this plastic everywhere. It's really irritating. But then a few years ago, I wanted to move back to working at the corporate level. And so I joined a company as an ESG consultant. And as Prof mentioned, there is the BRSR, India's sustainability reporting framework. And that's what I did work on for some time. And about 2 years ago, I got this opportunity. I heard about something called sustainable finance taxonomies. And I joined this organization called Alumni Global, where one of the things that we do, one of our verticals is the development and implementation of this thing called sustainable finance taxonomies. I was like, coming from the engineering background, not very familiar with finance, something that I, started learning. And I really do understand and appreciate the need for this. So I work in the APAC region, although my company is more based out of South America. I've worked on taxonomies for Philippines. We're working on the circular economy taxonomy. We're working on the Laos taxonomy, Hong Kong taxonomy, a few taxonomies in Africa as well. So that's what it is about me.
Fantastic.
Thank you for having me here, and I'm really happy to come back and talk with NTU folks.
Thank you. I have a million questions for you when we come back to you. So thank you for that. Atul, how about you?
Sure. Thank you. First of all, thank you, Professor, for such an insightful information and details about this ESG piece that I really have no such you can say have very less idea about this. But yes, being a banker for last 25 years, I got such an insightful information about all this. So thank you so much for having me here and getting all these insights. So hello everyone, my name is Atul Srivastava. I work with Yes Bank as a head of operation excellence. I am in the banking industry since last 25 years. I started with my career with, I work with all top 3 private sector bank of the country, and currently, with this institution since last 9 years. Have worked almost in all the area of banking, start from retail to SME to corporate and to now strategy and transformation in this bank. I really, really feel proud after going through these details from Prof that we as a Yes Bank we are consecutively since last 3 years we are the top bank in the country who are ESG compliant, who are sustainability in sustainability we are number 1, and we are the only bank in the in S&P that yearbook 2025 we are the only Indian bank who are listed for this sustainability piece from India. I think for me the sustainability for us, because you people might be aware that we as a bank we have gone through for a roller coaster ride, so we understand that how the sustainability is important, sustainable finance is important, and for me as a operations guy I understand and I believe that until unless you will not have a very compliant processes, very strong, the governance in the system, you will not be able to run the organization, and that's where I believe this particular piece come into the picture. So that's about me. We'll have the question answers, whatever we have.
Yeah, I've got more questions for you too. I mean, we're really lucky because we start with Manisha, who is working on what counts as green and all of that, and then we've got Atul, who's got the money, and now we actually get to come to Ashish, who runs a business that actually does stuff. And so we represent all the different parts right here on our panel. Ashish.
So good evening, everybody. I'm Ashish Garg. I run specialty carbon or specialty chemicals business for Epsilon Carbon. Essentially, we purchase coal tar from steel industry and convert that to useful products for different industries.
Try a little closer. Yeah. Okay.
So essentially, as part of Epsilon Carbon, we purchase coal tar from steel industry and convert that to useful products for various industries. I completed my MBA from NTU in 2004, long back. That is almost like 21, 22 years. And that too I completed after 10 years of working, a regular MBA. So I am very happy to be back in touch with NTU. I didn't had opportunity to work in Singapore. I came back to India. And one of the reasons why really I give a lot of credit to NTU for whatever I have done in life, not because of the breaks in job breaks NTU provided me, but because of the skills it imparted me. So during my course of my studies, I picked up a lot of things in terms of how to think correctly, how to communicate correctly in the most effective way, and that has really helped me in my career. So I am very happy to be back in touch with NTU guys, and will try to participate in whatever capacity I can in NTU programs. Now coming to the subject of the day, I have been practitioner of many things which Professor spoke today. So I have run manufacturing industry. I have run factories all my life. And I understand that whatever Professor was talking about, most of the problems related to sustainability can be addressed using simple Six Sigma techniques. It is process optimization. We have to run the plant in most optimized manner in order to emit less, in order to discharge less. Perfectly understand. I also understand how greenwashing is being done by industries in order to project that they are doing well on sustainability fronts. And having worked in different parts of the world, so I have run factories in 4 different countries. So I also understand that government regulations have got a lot of role to play in incentivizing what industries are trying to do. So I'll share my perspectives when it comes to that. So over to you, Professor.
Great, thank you. Yeah, I mean, we're really very fortunate to have such a great panel with all their experiences here. Manisha, I want to start with you, because if we follow the flow from kind of measuring at the start for a company, I referenced the fact that we have these frameworks and reporting standards and taxonomies. It's kind of a wonky, weird thing to really focus on in many ways, and I think it may not resonate with a lot of people. Can you help us just understand very simply what we mean when we say these things, and why do they matter? Like, why is this stuff important?
Sure, Prof. So, you were talking about ESG, right? Frameworks and standards. It's basically like you were talking about accountants that report the financial health of an organization. So just like the financial health of an organization, you also need to see the ESG health of an organization. So that's what all these frameworks and standards are there for. We want to be able to measure and manage the ESG components of the company. Now, what do we mean by ESG? That's environment, social, and governance. So when we're talking about these frameworks, guidelines, standards, a lot of these terminologies are really conflated, and they're very confusing even for practitioners, actually.
Absolutely.
Yeah, so I actually looked it up, just like, to get it right. So frameworks are, the in-principle, high-level, documentation which says, what you need to do. And the standards are like the more specific technical details of what needs to be, populated into the frameworks. So anyway, that's not that important. What I do want to convey is E, right? Environment. What does it mean? What do we put into these reports, right? These are metrics, environmental metrics. So this would be like GHG emissions, how much energy is consumed by the facilities by that company, how much water is consumed, what is the kind of wastewater discharge, and what do they do with it? Like you were talking about the tragedy of the commons, right? You just emit all your wastewater into the common river. So what do they do with the wastewater? What do they do in terms of climate change adaptation? Do they have any measures for that? And so on and so forth. That's what the E is for. And the companies have to report this so that their stakeholders can make informed decisions using that information. And S stands for social. So that measures how you treat the internal and external stakeholders. So that would be how you treat your employees, your labor practices, what sort of training do you give them, what are the wages like, how does it compare across community, the place where you're operating, how do you look after that? Because there are plants or facilities where they could be polluting facilities. How do they manage that? How do they engage with the community? It could include diversity, inclusion. These are all the indicators or metrics that are used for reporting for the S of the ESG. And G stands for governance, which is to do with like your anti-corruption, board oversight of the ESG issues. It could be like director accountability, and it could also be like for data privacy, cybersecurity. So it's a very wide spectrum of metrics and indicators that are covered in ESG. But all of this is really important. You were asking me why does it matter, right? So when people, especially investors, and we're talking about sustainable finance, when they're looking to invest in an organization, they're not, back in the day, they were looking at the balance sheets and they were looking at the financial health and making decisions based on that. But over the years, this has changed, and that's not the only indicator of health. ESG has become an indicator of the long-term health of a company. So when a company is doing well on these fronts, because that's what you were mentioning, that environmental issues are not going away anytime soon. So if a company is able to deal with ESG, then the chances are that it's going to do well. So these are reasons. It helps these ESG frameworks help companies to disclose and report this information, which helps investors or even customers, because there is a growing realization by especially the younger generation, right? They want to buy from more sustainable companies, and also they want to work for sustainable companies.
Right. Yeah. Their choice of employer increasingly might include something like, how sustainable is this company? What are its labor practices? What are its policies and practices with respect to environmental issues?
Exactly.
So now, okay, so I think you're making a compelling case that measuring these things is going to matter. Now, we talked about taxonomy.
Right.
Taxonomy is slightly different.
Yes.
Like, help us understand where that fits in. It's going to be a good segue over to a tool when we start talking about the banking, the financing. But help us understand this whole thing of taxonomies and what they are and why they matter.
Okay. Taxonomies are basically frameworks which help to mobilize finance towards green or sustainable projects, right? So these are generally developed by central banks or larger commercial institutions, and they basically are like a classification system, and it's voluntary right now. It's not mandatory, but it gives you a very holistic view of what is really green. it will ensure that there are technical screening criteria. I'll get to that, what that means. It ensures that you're making a positive contribution to environmental objectives while also having these safeguards. You were talking about guardrails, right? You have to ensure that you're not going to do any harm to the other environmental objectives in the taxonomy, and also having social safeguards. So this document ensures that there is no greenwashing that can happen. So it's a very credible way to raise finance, and it has a lot of use cases actually. And just to give in a nutshell, taxonomies generally have 6 environmental objectives, which are climate change mitigation, climate change adaptation, pollution prevention, biodiversity protection, water resource management, and circular economy. And usually 1 or 2 objectives are taken up at a time. And taxonomies are living documents, that I have to tell. In the beginning, they have to undergo expansion in scope. They have to undergo changes as technology advances. We want to be more ambitious in our technical screening criteria for the activities that we include into the taxonomy.
Okay, so you're back to technical screening criteria.
Yeah.
Can you give an example?
Okay, sure. So when we're talking about technical screening criteria, this is specific to an activity. So first of all, we would have to ensure that the sectors that we choose would be applicable to that particular country. Like for example, energy might be very material to mitigation objective, right? And there might be activities such as renewable energy, which is one of the activities which promotes mitigation objective. So if we have an activity such as bioenergy, right? So you would want a technical screening criteria would include the feedstock for bioenergy. It has to be sustainably sourced, So that's the kind of a technical screening criteria that has to be, that shows the positive contribution for that activity.
So you don't just get to say, oh yeah, we're doing bioenergy.
Yes.
You actually have to get into the detail of what's the feedstock that's being used.
Exactly.
Okay. I know one of the examples that sometimes comes up is also, we're all familiar with EVs, right? So in the EU, which put the first taxonomy together, my understanding is they originally included to be eligible for green financing, you could actually have some emissions per kilometer, basically like hybrids. But I believe that now actually it's only zero emission, full EVs, something
that's right.
So it's like grams per kilometer is an example, or what the feedstock is, right? Am I understanding that right? Yeah.
Yep.
So when I said that governments get to decide what's green, it's that, right? This is people like Manisha working hard with the government to say, how are we going to actually set appropriate criteria? And they're not the same across countries, right?
They're not the same across countries, but a lot of taxonomies are designed to be interoperable. This is to facilitate international financing and for usability also from investors' point of view, for them to be able to understand the language, for them to be able to compare taxonomies and invest across different jurisdictions.
Got it. Thank you. Okay, so she just said financing, which I'm going to use it to segue over to you, Atul. So when we were thinking about what to talk about on this panel, very clearly, I just spent way too long talking about financing these changes, right? So here we are, we've got somebody from Yes Bank on the panel. In your experience, where do banks start to bring in the sustainability elements to their financing decisions? And I don't know how much you can share with us about what that really looks like in practice.
Sure, Prof. So, if we talk about Indian banking, it's this particular piece of sustainability, inclusion in finance is more towards the credit decisions what a bank takes nowadays, right? Because when we talk about the sustainable finance, a long term, when we look at the long term value creation, how while taking the decisions during the any credit appraisals, what we look at that which type of projects these are. If these projects belongs to say for those particular areas where which relates to ESG, right? So we as a bank, and it's not like that's universal for every bank. Every bank has their own way of putting these factors into the decisioning. But yeah, they they understand the legal environments. They understand what are the government rules and regulations for this particular project financing, or say if you are financing for some infra project, if you are financing for say some something for mining, or if you are financing something for even for the manufacturing industry, what are the litigation which can come into the picture, where there will be a probably there will be a regulatory risk, or there will be a compliance risk, so all those factors comes together, and then this something which is being built in the financing in this particular area. It's not like as of now, because the regulation is not mandatory from a regulator side that yes, you have to do something like that. As as SEBI says, top 1,000 companies only have to do this BSBR reporting. It's not mandatory for banks as of now from regulator side, but yes, the bankers have started thinking about it, that what can give us a long how can I avoid my NPAs by incorporating those decisions into this particular piece, and then move forward.
Yeah, so is this yet in India a point of differentiation between banks? Are they starting to compete on kind of their positioning for sustainable financing?
You can say yes, because yes, there is a difference, because in India, if you see, there is a separate set of public sector banks who try to do these type of activities probably towards the infra projects, the public sector banks, and towards the inclusion, say financial inclusion, right, or even the MSME financing. So that's how they try to incorporate this sustainable finance into their picture. However, say if you talk about again private sector banks, so there are two type of private sector bank. One is say large private sector banks. So they will how they operate, probably they incorporate all those things into their policies, right? Their policies or the board level decisions, and then they used to finance into this particular sector. However, if you talk about mid or small sector finance, private sector banks, they have a different strategy altogether, because they are very, very conservative in this particular piece. They ensure that they only meet the regulatory requirement, or they only meet the compliance what is being expected from them, and then very conservatively they they put their efforts into this piece. So it's differ in India even between public sector, private sector, large private sector, or even mid or small private sector banks. That's how it is.
Right. This is one of the things that comes up in Singapore, which has actually been pushing on this a lot. The difference in understanding and to a certain extent capability between the MSMEs and the large companies. You just mentioned, I guess in India, it's the top 1,000 companies are BRSR covered, right? So that's a ton of companies that aren't. What have you seen from kind of a bank perspective in the area of providing some education for their customers as part of the role of providing financing? Is that starting to happen here yet?
Yes, so as even in your presentation, what you are mentioning, that you have to do it, right? Even in our bank, if you see, we are the only bank who is actually listed into S&P Global 2025. Now, how we are doing that? We are committed to do the zero emission by 2030. right? And as you rightly mentioned, we have to start educating people. So there is a very strong drive even within the organization. So people, so first we start doing this with our people. We have 20,000 people, right? 30,000 people in the bank. And we start educating them, and we also give them a mandate in terms of how this is going to play a very important role in coming in 2030 or 2035. What is the bank objective by, in say 2030, how are we going to be zero emission, achieve that zero emission by 2030, right? So yes, this will play a very important role by educating customers, but because we have India being one of the most regulated, country from a banking perspective, if you see, if those type of regulations, I think somebody was mentioning in the morning, while discussion, that all the frameworks are ready, and probably after budget that will be declared. And if those things are coming from a regulator in terms of the way it comes for financial inclusion, right? So that every bank is mandated to have to achieve the priority sector lending, right? So if those type of things will again be incorporated in terms of say instructions or in terms of regulation, that yes, this has to be done. So I think we'll be certainly doing that.
Just another, maybe more for my edification, is there yet here any real differentiation on different sustainability issues receiving special attention or dedicated types of financing yet? So sometimes you might think, oh, well, we have a specific bond or loan program for emissions reduction. Another one might be for adaptation or things like that. Is that starting to show up here yet?
So see, if you relate this even with priority sector lending in India, right? How it was evolved in, say, after Independence Day, there are multiple interventions which has happened in India for priority sector lending, and this, today each and every bank is forced to achieve this 40% of priority sector lending across their books. In a similar fashion, if this thing can also be, even built in, and then can baked in. Yeah.
So some of my former students are corporate bankers in Singapore, and have actually joined sustainable financing teams within some of the local banks. And I remember one of them, we were chatting a few years after he'd made that switch. He was like, profit was really pretty crazy because the mandate came down on high, or from on high, to go out and basically call every single customer and say, hi, would you like a sustainable loan? Like, do you want to do any kind of sustainability financing? Because the banks had KPIs, to your point, right? It's like, so if it's 40% to MSMEs or whatever it might be, then now imagine that all of a sudden the bank is like, you have to increase the number of sustainability related loans by X%, whatever that is, and then that filters out to your sales force, and they have to go out there and then they're all calling Ashish, right? Saying, okay, hey, you want some green financing? Well, I mean, what does this feel like to be on the corporate side?
Okay, so journey towards sustainability in corporate sector is kind of mixed bag. So if I talk about manufacturing, some of the journey towards sustainability is driven by cost, because organizations do gain if they improve their efficiency. Lot of improvement actually. If organizations want to optimize their cost, journey towards sustainability is a key step in the direction, and that makes them competitive. I have personally experienced it, but research also says that for every $1 which is invested, there is $3 to $4 returns, purely by improving efficiency. In one of the organizations, I could understand just by improving process control, the raw material consumptions could come down by more than 10%.
Wow.
personally experienced it.
Yeah.
Now, like I mentioned, some of the journey is driven by circumstances. In one of the organizations I was working, water availability was a major challenge. So there was no water available in summer season in Gujarat. Effluent discharge was a major challenge. So when we were setting up expansion, the local authorities which were supposed to evacuate the effluent was not able to do it. So what do? We set up a water recovery plant from effluent. Was recovering 25,000 meter cube of water every day, which is enough to supply a medium-sized city in India, medium-sized town. That is a requirement. Now, that situation came up because water is not available. If it is available, it is very expensive. Effluent cannot go down the drain. So what you have to do to run your operations is to recover water and make this a minimum discharge plant. So it is driven by circumstances. You need to optimize your cost. Coal prices suddenly go over the roof. From 5,000 rupees a ton, it goes to 10,000 rupees a ton. What do? You start purchasing agri-fuel to minimize your cost, driven by circumstances. But a sure movement in direction of sustainability, achieving sustainability. Now, in order to achieve sustainability, do I move from coal to natural gas? The business becomes unsustainable.
Why?
It cannot pay for it.
It's purely on price.
Yeah.
Yeah.
So there are commercial things. Now, for all the people who are sitting here, I want to ask you, if you go to a shopping mall and you get a t-shirt made of polyester, recycled polyester, where the look and feel is not the same as that of a virgin polyester, and the price is 50% higher, would you like to pay for it? Most of us would probably not care to do it. Then how the industry, ultimately, when we want to recycle the raw materials, we would like to have a better sustainability credentials. Who is willing to pay for it? You might have seen in today's presentation, the green bonds built on KPI is offering 0.02%. It is nothing.
That was the change.
Yeah,
right? The change, if they meet the goal, pay 2 basis points less. You're right. It is basically nothing.
So I am wearing the black hat today. I am playing the role of a black sheep. So 0.02% is nothing. If it is a $10 million, then the overall implication on cost is $20,000, which is probably very low in terms of overall cost of finance. So I can tell you, during my course of working with different countries, how countries have incentivized this using government policies. In Singapore, let me start with Singapore. In 2002, when I was there was this focus on new water because there was this dispute with Malaysia on water supply, and Singapore introduced new water, which was water recovered from sewage. And that is where Singapore emphasized the need to have water recovery from effluents, saline water. So it promoted a company called High Flux those days.
You really are going to wear the black hat. Keep going.
Say again?
You really are going to wear the black hat. Keep going with High Flux.
So it was Singapore which gave me the first perspective that incentivizing industry in the right direction can be a real pace to change. Let me go to China. In 2015, China came up with this new environment regulation to have the blue sky in Beijing during Victory Day parade. Now that really changed perspective. If the PM in a particular city was high, industries in 100 kilometers of that city were asked to close down. Full stop. I was working in Xiangyang city. There was a newspaper article that the Environment Protection Bureau chief of the city was demoted 2 levels down because he was not able to control the PM level of the city. Can you imagine this happening in India? So again, how government incentivizes, how positive movements and how government disincentivizes. Now, let me give you some more examples. Plastics. So we have a huge problem with plastics, right? I have been working in industry. So if you want to use biodegradable, compostable plastic, which are available, they are at least 2 times, 3 times as costly as a normal plastic, polyethylene or polypropylene. Who is going to pay for it? Are customers willing to pay for it? The answer is no. Is government willing to pay for it? The answer is no. Are shareholders willing to pay for it? You ask shareholders that, look, I'm using a compostable packaging and that will reduce profitability by 10%. Let us see what shareholders say. The share prices will go down. So who is willing to pay for it? Yes, the ideas are good. We would all like to have an environment which makes it sustainable for future generations to come. But are we going to pay for it? The answer is for all of us to answer.
Okay, so let me try to get you to take your black hat off. Are there, in your experience, investments that you've seen in improvements that are sustainability related that are actually positive ROI?
Yes, there are.
So,
yes, there
any
are.
examples off the top of your head?
I'll give you a couple of examples. In my own company, we had KPI-linked bonds, and we were able to deliver the performance. So there are projects in India which actually help in improving sustainability. For example, there is this Amrit Yojana, which is government is incentivizing this. So if companies would like to use sewage water which comes out of treated sewage water which comes out of cities. So every city government is providing with this Amrit Yojana centralized sewage treatment plants, which previously was not there, and much of the sewage was going directly into the rivers. Now if government has made it mandatory to use this treated sewage, and you can get loans to use that sewage water, I think. Okay. So there are areas where which can be where government schemes and loans can be leveraged for the sustainability projects.
Right.
I think I'll just add on here. There are a lot of corporate houses now. In fact, if you see a lot of buildings now use recycled water in India. So all of them use only recycled water. There is very less of fresh supply that comes.
Right.
So that's another big step that they have taken to be able to utilize the resource well plus help sustainability.
Yeah, I mean, very aware water stress is a huge issue here.
I'll
right?
give you another example. These days, government is incentivizing use of electric vehicles for transportation of goods. So I don't know whether it is linked to green bonds, but these are loans with lower interest rates, for sure. So our company, in my existing organization, we are converting from diesel-based trucks to electric trucks. And that actually helps in reducing our cost. It has a two-way impact. Makes it sustainable as well as reduces the cost. What is yet to be examined is that when we start using electric vehicles, what will happen to the batteries towards end of the life?
Yep.
That is
Still an unknown.
what will happen to the solar panels, which will reach end of life? What will happen to the windmills, which will reach end of life? Those are subjects which are not yet debated, not yet focused, and there is no solution to those problems.
Yeah, thank you. At this point, you were kind enough to prompt me. It's time for you guys to ask some questions. So we do have a little bit of time for some Q&A. Wow, very, very quickly. So can I invite, since you went first impromptu, can I invite this gentleman to maybe ask the first one? We have a microphone coming to you. So.
No, I think he wants him to ask.
Yeah, thank you. Then we'll come back to you. And then we'll hopefully, yeah, there we go.
Good evening, everyone. I'm Mandar. My question is, for example, you mentioned about electric vehicles and other sustainability measures in our country or any other developing country. But the major source of generating that electricity is through thermal power plants. So my question was, I'm a bit confused. I mean, even if a developing country goes through a lot of sustainable measures, but the source of the energy is still a problem, then how can we mitigate this problem, especially in any developing country or nation?
So that is partly true, partly, not fully. So as you might have noticed that a lot of government projects are working on solar power. So there is around 130 or 150 gigawatt of solar power and around 55 gigawatt of wind power installed in India. So the way things are planned is that in the daytime when solar power is available, the capacity utilization of thermal power plants go down. And in the evening when the solar power is not available, the capacity utilization of, and technical companies are working on reducing the turn down ratios of those power plants, so that even at 40%, if solar power increases, even at 40%, those thermal power plants can work. So to answer your question, yes, when electrical vehicles get charged, some of this electricity might be sourced from thermal power plants, but then the ratio, we have to look at the ratio, and that ratio is coming down.
Yeah. I mean, remember also that we got from 3.3 down to 2.4 without touching energy supply. So there's a tremendous amount that can be done, theoretically, right? Local context is always going to triumph over everything, right? So, but we have to do all of it. There's a tremendous amount of work being done in Singapore right now to try to figure out, from a financing standpoint, what can be done to encourage the early closure of coal-fired power plants. Now, I don't know what the average fleet age is in India. In Indonesia, for example, it's quite young. And so, you know, if I built a coal-fired power plant, why do I want to shut it down early, right? It's supposed to live for 30 years or more, and that's where I'm going to make my money. So they're trying to figure out how to do this through like a credit for avoiding emissions, right? Things like that. So tons of work being done, and we just don't have answers yet, I think. But thank you very much for your question. I believe you're going to be next.
Yes, for me. So, Professor, the buzzword today in the world is artificial intelligence and data centers, and all of these, and of course, bitcoins. All of these are very heavy energy guzzlers and totally anti to our ESG themes. How do you see this playing out in the future, in the near future, on how will we ever maintain that balance? Because all the countries today, and if I talk from an India standpoint, and well, I'm a finance person, so all the people around in the emerging market specifically who are getting money coming from the developed nations is largely moving in directions of where AI is getting built more. So obviously there's a lot of focus around this. How does this balance out on the sustainability theme?
It's a great question. I wish I had a great answer for it, but I think it's more that I share your observation of the problem. Singapore has a standard for green data centers. Yeah, sure. I'm wearing a black hat when I say that. I don't really believe that's not really a thing, right? But it could be greener data centers. I think the biggest issue is we forgot that Google can help us get answers too. And actually, so a Google search versus a ChatGPT or a DeepSeek search or anything else, Google is much more energy efficient, right? And so, but now you have so much stuff that used to be searched just through a search engine is now going through AI. It's a real problem. So I think you've seen some of the big companies saying, we're going to buy, nuclear facilities in the U.S. that have been either slated to close or have been closed. We're going to restart. It's going to put tremendous pressure on grid. Transmission is a problem, and I don't see it going down anytime soon in terms of overall utilization. And so it's going to further stress the problem. I don't have a good answer for it.
So, but do you think then maybe we'll need to take more measures on the other side? So like the En-ROADS that you showed, I think it's amazing. And that will also take up a lot of energy, by the way.
Web search,
So, yeah.
not AI. Sure.
I think that's exactly why I come from the technology space, linking sustainability to build technology solutions. And that's why responsible AI is something that comes the aspect that, yes, it is important, you need to use it, but then when it is required, when it's not required, right? And we talk about green data centers, even underwater data centers, right? So that you can really manage the amount of cooling and energy efficiency with that. So, I mean, I have a question which was linked to the Cam's point here, and I think Manisha very beautifully explained about the ESG aspects, ESG concepts. And when we talk about the social aspect, I think education plays a very important role, and the early we feed these sustainability concepts to our generations, the better it is. I mean, we talk about sustainable lifestyle to adults, but when we feed it to young minds, I think it really matters. So from your experience, have you seen it in universities, education sectors, anywhere globally where these things become a natural thing? I mean, I've read a lot about Japan. Of course, I'm sure in Singapore as well, but that is something that I would love to see in India if possible.
I mean, I'll take that as an educator. My experience in call it the U.S. I have a son studying in the U.K. and then I'm in Singapore, and I've seen lots of different attempts. Singapore is small enough that a lot of things can just kind of happen at the national level, so it happens.
We need a
right?
scaled solution.
Yeah, but in the UK you see a lot of different things happening, but not as coordinated at a national level, at least from what I hear from my son. And then in the US, nothing's ever coordinated. So
they don't care.
So we're having, that one's a little bit harder. I think it really comes down to how the education system works, right? Because if you have a well-functioning kind of national level education ministry that decides to care, it is possible to implement something. And I agree with you. I think the earlier we can get this topic in people's minds, the youth today, it helps, right? There's a wonderful club at NTU called the Interactive Investment Club. Interactive Investment Club. And actually they focus on financial literacy, right? And that's a big part of what they do. I'm slowly getting them to focus on sustainability as part of financial literacy. And they go do work out in the schools, like with primary schools and stuff like that. So it can be done, but yeah, probably isn't being done far enough, fast enough.
No, but there's something new that I have been seeing which just started catching up in India is in terms of what are you using ChatGPT for? How are you using AI? I think if you're able to use
Hmm?
able to at least answer some bit of that issue.
That would be wonderful to see. Um,
That's okay. To your point of underwater, you're
Yeah.
solving one problem, you're creating another, endangering aquatic life.
Yeah.
I mean,
Yes, good. Right. They talk about space data centers now too, right? Okay, good. Yes, please.
So this is more of a conceptual question. When you were talking about the technical screening criteria, Manisha, I heard Professor say that EV is almost negligible emissions now, but that is just on road, right? So do we also include the manufacturing of the battery and the end of battery life in the technical screening criteria, or is that not a part of the criteria?
Yeah, this is a good question. Actually, I did want to talk about this just because Ashish also talked about, end of life, right? So from a point of view of taxonomy, like I mentioned, we usually have taxonomy for a particular objective. And for the objective of climate change mitigation, then we have technical screening criteria that contributes to that objective, which is emissions. So that would not focus on the, manufacture of batteries. However, we do no significant harm, which is the guardrails like the professor was mentioning. So we have, the taxonomy has 6 different environmental objectives, and one of them is circular economy. So you have to ensure there is no significant harm done to the, basically at the end of life of the battery, right? So there is something called a life cycle assessment, which has to be done, LCA, has to be done. So that, looks at not just the, emissions, but it also looks at the material consumption and also the design. Like Professor was mentioning, you design for longer use, you design for dismantleability, you design for refurbishment. So all of these are taken into consideration to ensure that your battery can be reused. So this is being looked into already. Like for batteries, for solar panels, all of this, e-waste, right? That's a big, problem. And people are looking into it. It's not that, all of this end of life gets junked, but this is being designed for, longer, lifetime, for refurbishment, for dismantleability, recycling. That's a very important part.
Not only in terms of, let's say, products or consumables, but this is being done to buildings as well. So,
I mean, even buildings, built environment, even that goes through an LCA, and that is done at various milestones in the life of the building. So that is being done, and all your rating agencies, be it LEED rating or IGBC, USGBC, IGBC, GRESB, and there are many other rating systems. So these do consider your LCA, which is done at various milestones during the life cycle of the product, in this case, a building. So also, there's something called as the embodied carbon reduction, and we're talking about carbon credits and transferable carbon credits, and to reduce the embodied carbon content, there's also something called as a secondary steel, which is recycled, right? So reuse. So again, coming back to that LCA, that's something, old refrigerators, TVs, bicycles, I don't know. You extract steel from there and then you make it into a reinforcement which is used in the building. So you're effectively lowering the embodied carbon content by a whole lot. So it's too less, but yeah, it's being done.
in fact, I work for the Aditya Birla Group, and we have an e-waste recycling company. We are working on extracting critical minerals also from a lot of the e-waste.
Yep.
So that's also another very big project which is going on. So I think end use, we'll get there. I'm quite sure.
Thank you for that.
Just
let's do one more, and then I know, because we wanted to make sure that we can express our appreciation to the panel and then get everybody to some networking. Is that going to be a quick question if we get to? Okay, so comment and then question. And then we're
I
done.
don't have any question, but I like to kind of give a perspective on what is India's sustainability journey is about, and I'm from capital market. I think we are very realistic and very practical. And I'm slightly biased also, as I'm quite Swadeshi here. I'll give 12 out of 10 to India's sustainability journey so far. And there are many reasons, but I'll not highlight those. What professor taught us, this has been done 10 years back in India, okay? Sustainability bonds were raised in 2021 by Ultratech Cement, Adani Power, and recently, though these are private listed sustainability bonds, recently even the listed space, public listed space, two companies, L&T Finance, roughly $60 million, and Mind Space Real Estate, around $60 million they raised, and they got very good greenium in terms of, we raised the money at around 6% only. And they put a KPIs in terms of emission intensity and air quality index, and both got very huge discounts. This is one. Second very important thing, I'm seeing a lot of concerns around base load versus peak load versus renewable intensity. Trust you me, there are now being things spoken about that maybe are surplus in terms of renewable additions. So there's a lot of power in terms of peaking power, because I had the electric derivative markets, which is kind of giving a perspective on the future power market. Prices has gone down of electricity by 28% in the last 4 months. Why? Because we are in surplus in renewable generation. Evening peak, like Ashish told us, 4 p.m. onwards, when the solar goes down, there's a base load issue. Definitely, even all the conventional powers are not able to meet the demand. We are adding the battery storage. And I think you will see the solution in next 2 years, because there are a lot of PLI scheme coming from the government, and government is quite conscious of that, This is second. Third very important thing I think we all need to understand as Indians, and I'm very conscious on this because there's a thing called Kuznets curve. What is Kuznets curve? Everybody should understand this. Kuznets curve is a kind of reverse U, okay? Reverse U. So on the x-axis, there's a per capita income of a citizen, and on the y-axis is a emission intensity or emission of the carbon dioxide, SOx, NOx. It has been found that up to a particular level of income growth, the emission increases. And beyond that, it goes down, Europe has followed the same curve, US has followed the same curve, Japan has followed the same curve. Unfortunately, because our per capita income is less, Professor talked about emission intensity, we are following typical Kuznets curve. It is a 1971 theory by Simon Kuznets. This has been adopted by India very well, but we do believe that post 2035, and unlike other Europe or America or Spain, India is going to touch base that, inversion point very fast. This is the beauty of India. It's the beauty of India that even at not that high per capita income, we'll be touching that inversion point, and our emission is going to go drastically down after 2035. That's why we have kept 2035 as a net zero target for many, sectors. Just some points. India is doing really great. Last 2 years, we raised $40 billion in IPO markets. And out of those $40 billion, $21.7 billion this year, 19% last year. Roughly $8 billion money has been raised by green companies. Solar manufacturing, electric vehicles, climate finance, battery companies, and this is the largest in the world. So what I'm suggesting, India is on the right track. Keep hope, keep faith. Country is doing a good job. 12 out of 10. Thank you very much.
Good, thank you. Okay, I'm really tempted to end it there, but I did see the gentleman there who was very patiently waiting for the chance to ask a question. So we'll do one last question, and then we will call it and move outside.
Okay, good evening to the panel and to the audience. Before I ask my question, I'd like to establish something. I'm a bit of a special audience. This entire table is a bit of a special audience. We're prospective students of NTU. We're not alumni, or someone here said that we should educate the youth, and I'd like to say that we're examples. You're doing something like that.
Excellent. So just sign and come.
So the question I'm going to ask might look obvious to some people. I'm from a engineering background. I don't even have corporate finance, and I'm asking something based on sustainability finance. Why would a CFO or a CEO issue KPI bonds in the first place? It seems counterintuitive in terms of budgeting or profit. You issue a bond that is against your company's interest in terms of profit, and if you fail to meet the deadline, you'll be paying an hefty...
There is a clear advantage. If you come with a green bond, there's no greenium. The typical conventional bonds are being raised at the percentage of 7.7 to 7.6%. Just maths I'm telling you. So there's no greenium, you know. So people thought that if you'll go for green projects, maybe you'll get some kind of discount. CFO's thinking like. So they went for green bond, you know, no premium, no greenium. 7.8 went down to 7.75, only 5 basis points less, right? Now comes the SLB. Because in SLB, you are setting the KPIs and you are saying that I'm not greenwashing. I'm serious here. I'm setting the KPI first and I'll show you the number now. No, they put 2 KPIs and they said post third year, I'll be levying upon myself a penalty of 10 basis points each. If I fail on emission intensity, my coupon yield will increase by 10 basis point, first point. And second point is, if I fail on both, 10 basis, 20 basis point. You know, taking this upfront responsibility and accountability on myself and showing my seriousness around sustainability targets, my discount, 2%, 200 basis point. From 7.75, I get down to 6%. You got my point? So that's the advantage. I'm not putting a kind of extra cost on the company by showing me responsible to sustainability, by showing that I'm ESG conscious, and I know what I'm committing here. You are taking away the greenwashing concerns and getting upfront discounts of at least 170 basis point is a very good smart strategy. And
right.
We have seen both the cases, be it in L&T Finance, be it in Ultratech Cement, be it Mindspace, everywhere they got huge discounts. So they actually discovered the greenium through SLB, which they never discovered in green bonds.
If you're not a banker going out and trying to sell these bonds, you should be. I
do it.
It's a wonderful question. I think the answer is very contextual because we don't see that in Singapore. We don't see that in Europe. And in fact, the risks of greenwashing, I would argue, are higher on sustainability-linked bonds than on green bonds. But the general question, I think, is why would a company bother to issue any kind of sustainability-related bond versus just a vanilla bond? Because it actually costs them more to issue a sustainability-related bond. So they have to find either a specific case where they believe they can get a lower rate that saves them money, or they think that they're going to gain by looking good. And that's greenwashing. So it just, depending on where you sit, if it's this way in India right now, where you can actually get a good greenium, if you're a good company with good plans and a good KPI and all of that, hallelujah, go raise the money and get it done, right? But I think if you look around the world, you need to look critically, and this is the part I didn't spend much time on, the investor perspective, but hopefully you'll come to NTU, and I will see you there, and we'll talk more about it. All right, guys, thank you very, very much for your time and attention. Big round of applause for the panel. Thank you.